Have you ever had a loan in India and just wondered why your payments don't seem to budge right after the news is buzzing about an RBI rate cut? Well, the answer to that mystery is a really big shift in banking called the External Benchmark Lending Rate, or EBLR for short. So we're going to break down exactly what that means and, more importantly, how it directly connects to the money leaving your bank account every single month.
So here's the game plan. First, we're going to dive into this really frustrating issue that made this whole change necessary in the first place. Then, we'll take a look at the kind of clunky old system and see how the new one is so much better. After that, we'll get into the super simple new math behind your loan rate, and we'll wrap it all up by weighing the good and, well, the not so good of how this whole thing affects you.
All right, so first things first, why did we even need a whole new system? It really all comes down to this one single, persistent headache, the transmission problem.
You've totally seen this happen, right? The headlines flash, the RBI cuts interest rates. You think, great, my loan payments are about to get cheaper. But then, crickets. For months, nothing changes. That gap, that frustrating delay, that is the transmission problem in a nutshell.
Now, the official fancy term for this is monetary policy transmission. But all it really means is the chain reaction that's supposed to happen. The central bank makes a move, and that move should create ripples through the entire financial system, flowing all the way down to the interest rate you pay on your home loan or your car loan.
And honestly, this is the perfect way to picture it. For years, the financial plumbing in India was just severely clogged. The RBI would turn on the tap, sending out a flood of cheaper money, but for you, the borrower, it was just a trickle, if you were lucky. The system was basically broken.
So what was actually causing this massive clog in the pipe? Well, to get that, we need to take a quick look back at the old system, which was built around something called the MCLR. India has actually tried a few different ways of doing this over the years. Way back before 2010, there was something called the BPLR. Then we switched to a base rate system. In 2016, we got the MCLR. Each one was an attempt to fix this transmission problem, but MCLR, well, it had a huge fundamental flaw.
And here it is, the absolute core of the problem. MCLR was an internal benchmark. That meant each bank got to cook up its own rate based on its own secret recipe of internal costs. It was complex, it wasn't transparent at all, and it gave them a ton of wiggle room to just not pass on the RBI's rate cuts to you.
So the RBI knew this just wasn't working. Something had to change. And in 2019, they rolled out the solution, a real game changer, the External Benchmark Lending Rate, or EBLR. And just look at this. The difference is like night and day. On the left, with the old MCLR system, the bank was basically a black box. You had no idea what was going on inside. But on the right, with EBLR, everything is tied to a public, external number that anyone can see. That one simple change makes the whole thing transparent and, most importantly, fast.
Okay, so what are these external benchmarks? Well, they're just publicly available rates that are completely outside of any one bank's control. Things like government treasury bill yields, or rates published by an agency called FBIL. But in reality, most banks just use the most obvious and direct one, the RBI's very own repo rate.
Okay, so that's all the theory. But how does this actually play out when it comes to your loan? How do they calculate your payment now? Well, the new formula is, thankfully, super simple. Seriously, that's it. Your total interest rate is just the external benchmark plus something called a spread that the bank adds on top. So, for example, if the RBI repo rate is, say, 6.5% and the bank spread is 2.5%, your interest rate is exactly 9%. No more mystery math. It's clean, it's simple, it's transparent.
So you're probably asking, okay, what's this spread? Good question. This is the part the bank still decides. It covers their business costs and, this is the important part, the level of risk they think you represent as a borrower. Your credit score is a big deal here. But, and this is key, the bank can't just change this spread on a whim. The rules say they can only change it if your credit profile itself changes in a major way.
All right, let's bring it all home. What is the real-world, on-the-ground impact of this new system on your wallet? Let's break down the pros and the cons.
Wow. I mean, this visual just says it all, doesn't it? Under the old MCLR system, you could be waiting for months for a rate cut to finally show up on your statement. Under EBLR, the change is practically instantaneous. The moment the RBI makes a move, the benchmark for your loan changes at its next reset date, which has to be at least every 3 months. That clogged pipe is finally clear.
But
And this is a really big but. It's super important to see both sides of this coin. Yes, you get amazing transparency and you see the benefits of rate cuts way faster. But this is a double-edged sword. The system works just as fast in the other direction. So when the RBI has to hike rates to fight inflation, you feel that pain much, much faster too. Your EMIs can definitely be more volatile now.
When you really boil it all down, though, the shift to EBLR has been a massive success at what it's set out to do. It's made the RBI's policies way more effective, and for you, the borrower, it's brought a level of honesty and transparency to loan pricing that just never existed before. You finally know exactly why your rate is changing.
And all of this leaves us with one last, pretty important question to think about. We've gained speed and transparency, which feels awesome when rates are falling. But in a world that can be pretty volatile and uncertain, is that instant, unfiltered exposure to rate hikes always the best thing for a borrower's budget? It's definitely something to chew on.